Then how do we recognize the compensated absence, like the sick pay or vacation pay? So it should be recognized as an expense and related liabilities in the year employees earned. And it should be also the updated and vested and accumulated along with the salary expenses. And all the payments of compensation should be probable, and the amount can be reasonably estimated based on the past the exercise or vested, accumulated, or update from these compensation absence transactions. And then journal entry is again the simple. On the debit side, we recognize that compensation expense, always expense, and then until the company pays to employees, should be recognized as the compensation payable on a credit. So let's go to this exercise. ABC has an employee benefit plan for compensated absence that grants all employees 15 days of paid vacation for each full year of employment. So unused vacation time can be accumulated and carried forward to preceding years, and also will be paid at the salaries in effect when vacations are taken. Okay. Additionally, employee benefit grants all employees 15 sick days, which is carried over indefinitely. So the exercise right is carried over. And however, no payment is given for sick days not taken. There was no employee turnover in 2005. In this case, additional information, accrual liability used from January until October before salary increase $30,000. Then beginning accrual liability for vacation pay is $80,000. So that is the given number. You don't have to calculate anything about this. And the vacation pay earned for 2005 adjusted to current increased rate as below $35,000, which is given number. But we need to take into consider the 15% of the salary increase rate to all employees on November 1. That is the point. So let's go to the journal entry. During year 5, vacation used. So when the employee used this vacation pay, then let's go to the easy one. Cash out. The company should pay to the employee. How much is that? Right, $30,000. Then on the debit side, compensation payable, because employees used the compensation balance. So the company doesn't have a liability by $30,000. Okay, I already put the $80,000, the compensation payable, which is the beginning accrued liability for vacation pay, $80,000, in order to match between two total asset and total liability equity. I just intentionally put $80,000 in cash. That's the starting point for the balance sheet for these transactions. And then November 1st, year 5, vacation pay newly earned. How much is the amount of newly earned? Vacation pay earned for 2005, that is the after adjustment of this increased salary. So $35,000. It's simply $35,000. Then how do you recognize that is newly earned? When the employees earned the vacation pay, then the company owed to pay this vacation pay amount. So let's go to the credit account first. Right, the compensation payable. Compensation payable, when we recognize compensation payable until the payment, that is the expense recognition point. So vacation pay expense. And then the vacation pay residual updated. What does that mean? Now, the ABC provided 15% of salary increased, but when the employees received the vacation pay prior year or previously before this salary increased, right? That is this $30,000 or $80,000, right? $80,000. Oh, not 30,000. That is a used one. The $80,000. But the employee used the $30,000, so they already paid the $30,000. So the update is only $80,000 minus $30,000 the employee used. So the remaining is only $50,000. So this $50,000 should be updated by 15%. So we put the vacation pay expense additional amount, and then compensation payable the same amount. So I'm gonna show you how to do it here. That was the beginning the vacation pay, right? The balance and minus employee used $30,000. So the remaining is the $50,000 should be increased by 15%, right? Increased by 15% because the salary increased. So $7,500 should be additionally recognized as vacation pay expense and compensation payable until the payment. Okay. Then let's record the compensation payable minus 30,000 and cash out when the employee exercised. So we balanced out, and then the vacation pay expense $35,000, which is negative in the income statement. Then now compensation payable should be added when the company when the vacation pay newly earned. So 85,000 increased. Then this retained earnings should be correlated. This the vacation pay expense. Then it should be the same. So we balanced out, and then finally the residual the vacation pay updated by 15% of the remaining $50,000 times 15%. So we also record this vacation pay expense by $7,500, and then compensation payable, additional compensation payable, $7,500. So we balanced out. Okay. So that's all. See you in the next video clip. Bye bye.